Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending June 21st, 2024. Just maybe some housekeeping before we get started. Vacations are starting at the end of the day for me, so the next edition will be on July 19, 2024, so in 4 weeks, and it will be just before the decision from the Bank of Canada. Which is scheduled for July 24th. We do expect to see another rate cut then, and we'll explain why in this review here. But in a nutshell, the conditions that were favorable to a cut in June should still be present and at the next decision in late July, at least if inflation continues to behave in the way that we expect it to continue to behave. So we should have another rate cut here there, but inflation, we have two inflation reports until that decision, so there's still some room for some surprises here, but we will be able to dig into that the Friday just before the decision in July. So if we start with this week's markets at the close on Thursday, so volatility again, rates are higher, so negative for fixed income. The TSX at some point was close to the top of the pack, but now it's slipped back. We're at 4.5% year to date. Nasdaq is closing in on 20% in local currency. S&P 500 is above 15%. Europe and emerging markets are hanging in with a strong performance this week, close to 2% for emerging markets. Price of oil kind of cut in the trading range of $75 to $90. So this is where the balance between demand and supply is keeping it. We're close to the bottom of the range recently. We seem to be growing within that range now. So we're close to 5% on the week, $82 on oil. Price of the Canadian dollar rather higher on the week. Euro going nowhere. The price of gold also stuck in a trading range between 23 and 2400. So getting closer to the top of the range here on the week. So maybe first interesting topic, looking at economic surprises between the US and Canada. And there was this conversation about, well, the diverging of the monetary policies between Canada and the US could lead to some weakness on the Canadian dollar, and it's reasonable to expect that. And we did run a model. We did estimate that there is negative relationship between the gap in monetary policies and the Canadian dollar for sure, but there's other factors at play, and one of the important factors is the divergence between the surprises between the two countries. So economic surprise. This is what you get here. This is an index from Citi. So what they look at is they look at expectations from investors, from economists, and what happens in the economic data. They build an index. So if the data is better than expectations, you have positive surprises and the index goes up. And if data is worse than expectations, well, the index goes down. Pretty simple. So red is Canada, blue is the US here. As you can see, during the winter and the spring, surprises were typically negative in Canada. Of course, now expectations might be a bit lower. That also plays into the fold. But now surprises are getting pretty much neutral and even slightly positive recently in Canada, while in the US, pretty much the other thing. So the economy started underperforming expectations. So if you integrate that into the outlook for the Canadian dollar, if you think that the easing of monetary policy in Canada will actually be positive for the economy, should blow in the sails of the Canadian economy, well, then we could expect this divergence to continue, that this actually supports the Canadian dollar to move higher. So we could have a scenario where the Bank of Canada continues to cut while the Fed is staying on hold for a few more months. The divergence between monetary policy continues to widen, but if it helps on the economic side, the Canadian dollar could go nowhere, could fall less than expected, or could even appreciate in this environment. So just wanted to keep that in mind, that there are some limits to the divergence, but it's not just about monetary policy. And talking about the Bank of Canada, they discussed many things at the latest decision when they cut on June 5th. Now we have the summary of the deliberations. You have a few highlights on the left here from CTV News. But they did discuss those limits. They said there are limits to the divergence, but we're not close to reaching these limits yet. So where is the limit? Well, big question mark, but they estimate that we're not there yet. The conditions were favorable to starting cutting in June, but although they did say that they considered holding until July. And this is reasonable. We discussed that in a previous video. That the odds were about 80%, which we thought was fair. The case to cut was there, but it would have been reasonable also to wait until July when there's a monetary policy review and there's more material that is being produced for sure. But they decided to go until the next decision on July 24th. We'll have 2 inflation reports in the country, so those will be very important. And there's one coming in next week. Expectations are that we'll go from 2.7 to 2.6% on inflation on an annual basis. So that would be another step in the right direction. But we think that the odds are that we will see another rate cut. Market is pricing in about 60-65% odds, so it's rather priced into the market. But there is some risks based on what inflation does until that date. So the market on the right is pricing about 2-3 more cuts by the end of the year. So we think this is fair. We expect 3 to 4 cuts in 2024 also from the Bank of Canada. Now, looking at the markets, well, the outperformance of the S&P 500 versus its equal weight index is getting stretched again. This is very important. Of course, this is led by NVIDIA and by big tech, and you know the story here. But the moral of the story is that it's only a handful of stocks that are outperforming. And the question that this chart is asking is, well, when you see a strong outperformance or underperformance from the index versus its equal weight version, typically there's a return to the mean, and there's a reversal to that trend. So is it imminent? We never know. But if you are overweight technology, if you have a lot of your money into technology, well, the chart here is suggesting that it might be a good time to start rebalancing your position, at least your sector allocation, because typically when you have that, after that there's a period where investors are taking profit in the winners and then start buying the sectors that have been left aside, like the cyclicals, like the defensives, energy, for example. So these sectors could be ripe for an outperformance. So again, not the best timing tool here, but what you can see is that when you have these outperformances that are appearing in the market, typically it's a good idea to start reassessing your sector allocation and to rebalance your portfolio. So very interesting development here. Also, in the second quarter of this year, we've had very strong performance from the S&P 500. But when you look under the hood, well, I don't know if the Magnificent Seven is still a thing, but if we play the game and we say that Magnificent Seven is still a thing, these 7 names are responsible for more than 100% of the returns. The 493 other names have a combined return that is negative since the beginning of the year. So that tells you since the beginning of the quarter, rather. So that tells you everything you need to know about the performance of the S&P 500 within the quarter. It was just a handful of names. So again, a great idea to start considering rebalancing your sector allocation. So what we'll be watching next week, CPI inflation in Canada should continue to behave accordingly. So 2.6% year over year. We think the conditions will be right for another rate cut in July, and this is the first step in that direction. GDP growth should be a bit hotter, 0.3% month over month, so it would be good news there. In the US Conference Board Consumer Confidence Index, GDP growth revisions for Q1, durable goods orders, and core PCE inflation. So a packed week, but the last item here, this is the inflation number that the Fed is focused on more. It's focused on the most at 0.1% month over month, 2.6% year over year. Those would be, again, more steps in the right direction for likely having a first cut by the Fed. maybe not before the election, but by the end of the year. So that would be good news here. Markets will definitely cheer that one. So that wraps it up for the week. Always a pleasure to serve you. As I mentioned, the next review will be on July 19th. So until then, if you appreciate the content, please don't hesitate to share. And if you have vacation, well, enjoy your vacation as well.